Hello and welcome to our financial year in review. Fighting inflation was the name of the game in 2022. Central banks around the world raised interest rates to clamp down on rising prices. China was on a different trajectory, as its pursuit of zero COVID infections caused economic activity to slow down. China's weak growth, coupled with tighter financial conditions in many regions and the lingering effects of the COVID-19 pandemic, would decrease global growth.
In 2022, central banks tackled rising prices brought about by bottlenecks in the supply chain, labor shortages, and increased demand as major economies recovered from the COVID-19 pandemic. At the beginning of the year, the global economy was expected to remain on an expansionary track in 2022. For large economies, analysts estimated GDP growth at around 4% in 2022. China would be forced to take a different path as the economy hit a slow patch. It set the GDP growth target at around 5.5% for the year because it faced triple pressures of shrinking demand, disrupted supply, and weakening expectations. The coronavirus and the lockdowns on the mainland remain a major hurdle for economic recovery.
So the lockdowns we have seen more recently, this still could have an effect when it comes to achieving that 5.5% growth, both from a disruption potential disruption of supply chains and manufacturing, as well as, very importantly, this has come through in recent data, the impact it's had on retail sales and consumer sentiment.
In February, Russia's war in Ukraine caused disruptions to the supply chain and higher energy costs. The price of Brent crude oil rose to about $130 a barrel in March. And then from August, the price steadily dropped to about $80 a barrel amid market uncertainty over a looming global recession. The war in Ukraine increased the price of commodities, which had a knock-on effect on the price of manufactured goods. Many metals were produced in Russia and Ukraine. Johnny C. ran a toy company. His factory was based in Zhongshan, China. Johnny used a lot of aluminum in his products. He said since the war, the price of aluminum increased by 25% year on year.
And this is a full metal-based microscope. And the material cost itself has cost 70% of the production of this item. So this product we have to increase almost 15% in price this year.
So when you increase the prices of your products, are people buying?
Some do, most of them don't.
With the increase in the price of raw materials and weak demand from his European export markets, Johnny's forecast 2022 sales would be 15% lower than last year. Lockdowns in the manufacturing behemoth of Shanghai in April and May exacerbated disruptions in the supply chain. Tim Huxley ran a company with a fleet of 4 ships.
So with the recent lockdown in the Shanghai region, how does that affect your ships?
Well, it means that they're sitting idle for a while to go in to discharge and load again, so that can be quite frustrating. So delays off ports have been a real problem for the last year or so, and in terms of Shanghai, it's acute at the moment with about 400 ships waiting to unload.
So how does that affect the supply chain then in the long run?
Oh, that has a huge impact on it. The problem is that you've got goods coming into China that are needed in the whole manufacturing process, and they can't get to the factories where they're needed because of testing and because of the infection rate. There's been a big decline in the availability of trucking capacity, and obviously so you can't get the containers either into or out of the ports.
Industrial output grew 3.8% in July from a year earlier, below a 4.6% increase expected by analysts. Retail sales, which only just returned to growth in June, rose to 2.7% in July from a year ago, missing forecasts for a 5% growth. The grim set of figures indicated the world's second-largest economy was struggling to shake off the second quarter's hit to growth from strict COVID restrictions. By October, China's exports declined by 0.3% year-on-year, the first drop in over 2 years because of weak external demand and supply disruptions due to coronavirus outbreaks. The property sector, which made up about 25% of China's GDP, was also a drag on the economy. Housing prices across 70 cities fell by 1.4% in October from a year ago. Residential housing sales for the first 10 months of the year dropped by 28.2% year-on-year. A slowdown in economic growth, uncertainty about ongoing COVID controls, and worries about future income dampened appetite for buying homes. By the second half of the year, Beijing introduced a lot of policies to stimulate the economy. In August, the People's Bank of China lowered interest rates on key lending facilities for the second time this year. In November, regulators issued a 16-point plan to rescue the real estate sector. Key measures range from addressing developers' debt problems to loosening down payment requirements for home buyers. Many saw this as an end to the 2-year crackdown on the sector. In 2020, Beijing imposed widespread curbs on lending to property developers, which exacerbated their liquidity issues. Several developers, including Evergrande, defaulted on bond payments, and some developers failed to complete projects, sparking mortgage boycotts and protests from homebuyers. China's central bank cut the amount of cash that banks must hold as reserves in December. The People's Bank of China cut the reserve requirement ratio by 0.25 percentage points, which would inject about $70 billion in long-term liquidity. This was the second cut of the year. And in December, China pivoted from its zero-COVID policy, eased quarantine and lockdown restrictions, and rolled back coronavirus testing requirements, and canceled the health code system, and economic activity started to pick up. China's economy grew 4.8% in the first quarter, then 0.4% growth in the second quarter, and 3.9% growth in July to September. But still a far cry from the official GDP growth target of 5.5%. Supply chain shortages and surge in demand caused inflation in the U.S. to jump to 9.1% in June year-on-year, a 4-decade high. The U.S. Federal Reserve aggressively raised the Fed funds rate by 7 times to 4.25% to 4.5%. The goal? To reduce inflation that was eroding the purchasing power of Americans without sparking a recession. Fed Chairman Jerome Powell said the central bank will deliver more interest rate hikes next year. He indicated that the key short-term rate will reach a range of 5% to 5.25% by the end of 2023.
We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
The U.S. economy contracted by 1.6% in the first quarter and 0.6% in the second quarter. It grew to 3.2% in the third quarter thanks to an increase in consumer spending. The U.S. added 263,000 jobs in November, and the unemployment rate remained steady at 3.7%. The International Monetary Fund estimated that global inflation would peak at around 9% this year. The European Central Bank, Central Bank of England, and other central banks also raised rates throughout the year. The IMF lowered its full-year global growth forecast to 3.2% because of China's weak growth, Russia's war in Ukraine, and higher cost of living. Tensions between the world's 2 largest economies remained high. President Xi Jinping held his first in-person meeting with U.S. President Joe Biden ahead of the G20 summit in Bali in November. The Biden administration developed a strategy to compete with China, which was focused on investing in U.S. competitiveness and aligning with allies and partners. In October, Washington blocked exports of advanced computer chips to China without a license. Chips are vital for everything from smartphones and self-driving cars to weapons manufacturing. The U.S. also banned Americans and U.S. enterprises from providing technical assistance to some Chinese chip makers. U.S. officials said the move was to protect national security interests. China slammed the U.S. for clamping down on Chinese enterprises and weaponizing technological and trading issues in violation of fair competition principles. Later in October, Beijing released an 8-pronged approach to beef up the digital economy and increase the country's international competitiveness. These include pooling resources to pursue breakthroughs in core technologies, ramping up construction of digital infrastructure, and stepping up digital innovations. In the final days of 2022, the U.S. added 36 Chinese firms to a U.S. trade blacklist to slow China's development of technology. The list included China's largest memory chip producer, Yangtze Memory Technologies, which was accused of violating U.S. export controls by supplying Chinese telecom equipment maker Huawei. When we return to how China-U.S. policies affected Hong Kong, and the Hong Kong government lifted some COVID-19 pandemic restrictions. But was that enough to buffer the SAR against external headwinds? Stay with us.
Welcome back to our financial year in review. In 2022, Hong Kong fell into a recession the second time in 3 years because of external headwinds, rising borrowing costs, and cross-border supply chain disruptions. But there was some glimmer of hope as the city began to pivot from its COVID-0 policy and allowed economic activity to resume.
In Hong Kong, the continued fight against COVID would dominate the political and business agenda.
Independently, Hong Kong has little decision-making ability these days. So we are part of the mainland, and as long as the mainland's policy is zero COVID, Hong Kong will have to stick with that. Like it or loathe it, it's just the reality. But quarantines and the rest are driving business out of here.
Coronavirus again put a damper on the opening days of the new year, with the emergence of a new variant of the virus, Omicron. Strict COVID measures were imposed to minimize infections during the fifth wave, with gyms, bars, clubs closed and dine-in services ending at 6 p.m.
In the past couple of weeks, already there are about 2,000 restaurants have been temporarily closing. And probably there are more than 300 restaurants have already closed down permanently. Starting from February, we are facing the worst time in the history for the catering industry. We are losing almost 200 million in business per day in February. So for the whole month, we are going to lose about 7 billion Hong Kong dollars. And I'm afraid that it all comes because of the new restrictive measures imposed by the government.
At the height of the fifth wave, the Hong Kong mainland border was closed to the SAR's container truck drivers to minimize the risk of infections in China. Industry representatives and the Hong Kong and Shenzhen authorities developed an alternate method of transporting goods from the mainland to Hong Kong by sea. A 12-hour trip from the mainland factory to Hong Kong became a 3 to 4 day operation.
For the cost, originally we used the cross-border truck is about $3,000 per trip, but now it's talking about $15,000 to $18,000 per trip for the whole trip, including the ship, including the domestic truck and Hong Kong local truck. No matter time, cost is increased a lot.
Antonio specialized in transporting freight from southern China to the Hong Kong airport cargo terminal. And his business ran a deficit of almost $1 million per month since February because of the bottlenecks and rising manpower and transport costs. Problems in Hong Kong's logistics industry and a worsening global environment caused exports to drop 4.4% in the first 10 months of 2022 compared with last year. The government rolled out a $170 billion spending plan to provide support for people being impacted by the pandemic. Financial Secretary Paul Chan announced there would be another round of consumption vouchers of $10,000 per person for residents aged 18 or above.
疫情平穩之後，為市場注入動力， I hope that the scheme will inject impetus to the market when the epidemic is stabilized so as to accelerate economic recovery.
Despite the government handouts, retail sales decreased by 1.3% in the first 9 months of the year versus 2021. Inflation grew at 1.9% in the first 10 months year-on-year. Food prices increased significantly by 3.9% in the third quarter from a year ago, causing residents to tighten their belts. Instead of splurging on pricey foods, Vivian Wan only bought what was necessary.
All this has increased in price. And so now it used to be I would do this. I would go, oh, I would like one of this, and I'm gonna take one of this. And then it's like, oh, and I like this. And then I wouldn't think, I wouldn't even look at the price. Now I would just see what is it in my pantry that we don't have, and then I'll just take one.
By mid-2022, more than 113,000 residents left the city in the previous 12 months because of strict pandemic control measures and changes in the political system. That's meant a decrease in the workforce, and employers have had a difficult time finding the right people to fill positions. The unemployment rate dropped to 3.7% in the September to November period. Thomas Hui was a branch manager for a property company that sold real estate in Japan. He was always hiring new sales agents because of the high turnover.
When they start to join our company, they need to pick up like all the knowledge from the Japan's property. So let's say if within that 3 months, if they cannot complete their sales target, what they earn is only their basic salary, which is very small for them. As we all know, like salesperson, the commission is the biggest part of their salary.
The realty company increased its basic salary for a salesperson by 20% from $10,000 a month. The slump in Hong Kong's property market accelerated as an exodus of residents added to the selling pressure, and borrowing costs rose. Prices of lived-in homes had their worst month in October. The government's residential property index fell to a nearly 5-year low.
Maybe from the current housing price, there should be a further downward compression. Now the price is starting to be softened, during this moment, because everyone which is taking the wait and see approach.
Secondary home prices fell more than 10% this year, and rental prices dropped 4% from January to November, as homeowners opted to rent out their flats rather than sell, causing a glut in the leasing market. By December, local banks raised their best lending rates by 25 basis points following interest rates hikes by the Hong Kong Monetary Authority and the U.S. Federal Reserve. This was the third increase in prime rates by local lenders this year. A major government policy shift came in September when John Lee announced a cancellation of mandatory quarantine for overseas arrivals after 2 years. At times, quarantine was 21 days long, and it was a big deterrent for visitors to the city.
We want to introduce measures that we are confident of maintaining the control of the overall epidemic situation. The intention is to do it progressively and orderly.
Visitor arrivals grew to more than 330,000 in the first 10 months of 2022. But that's still a far cry from the 56 million visitors in 2019. The mainland pivoted away from their zero-COVID policy in December, and Hong Kong further lifted COVID restrictions in the last few weeks of the year. Live music returned to bars and restaurants. Eateries resumed normal operating hours. Truck drivers were allowed to collect goods directly from the mainland. Arrivals to the city who test negative for COVID could move around freely. The Leave Home Safe contact tracing app was cancelled, but the vaccine pass was still enforced. The Hong Kong mainland border was still restricted. Relaxation of some COVID measures would stimulate the local economy, but it may come a little too late for 2022 as the government forecasts a full-year contraction of 3.2% due to a worsening global environment, affecting the city's exports and tightening financial conditions. In the first half of 2022, the Hong Kong stock market underperformed, but this was not limited to equities. Other asset classes such as bonds and some commodities, along with other foreign exchange values, were put under pressure. The main negative factors were the high inflation in the West and the Ukraine war. Most researchers have found that higher inflation has generally correlated with lower equity valuations. Inflation hurts stocks overall because consumer spending drops. The US and Europe saw the highest inflation in 30 years, forcing the central banks to tighten monetary policy very aggressively. And this led to a drop in sentiment as investors believed there was a recession on the way. The higher prices led to higher costs for listed companies. The strong dollar and rising bond yields were other negative factors in the first half. But it was the war in Ukraine that triggered some of the worst selling in the first half, plunging the Hong Kong market into bear territory within a matter of days. The continued lockdowns in China didn't help sentiment either.
In China, another big negative is lockdowns in some cities, including Shanghai, around the first quarter. It caused disruption to factory production and economic activity in general.
The Shanghai lockdown in March was a particularly strong drag on the market because of the impact the lockdown had on the Hong Kong-listed Chinese stocks. Robust bargain hunting between late March and the end of June saw Hong Kong stocks recover to a 6.5% loss. The fight against inflation continued to hit sentiment in the stock market. Between June and December, the U.S. Federal Reserve raised the interest rate 5 times for a total of 7 increases in 2022. The stranglehold on credit sent the HSI plummeting by more than a third until November. That's when regulators in China threw the mainland property and technology sectors a regulatory life raft, promising to bring relief and encourage investment. Also, investors were cheered by a moderation in prices, easing fears the Fed would kill the economy along with inflation.
The interest rate upcycle will be ended at around 5%. Or 5.25% in the first quarter of the 2023. And that's why it will have a better investment atmosphere.
The local market began a long clawback from below 15,000 to nearly 20,000 by mid-December. Initial public offerings on the stock market slowed in the first half. The total volume raised in the first half of 2022 was $2.7 billion from 27 deals. A 91.3% drop from the same period last year. On the upside, Hong Kong saw an increase in IPO activities during the third quarter, with 27 IPOs raising a total of $6.6 billion, more than twice the proceeds raised during the first 2 quarters of 2022. With 4 more days to go, it looks as though the local market will squeeze out a loss of less than 20%. With prospects for 2023 looking slightly brighter than 2022.
That's the show. Thanks for watching. Money Matters returns next year with a look at what's in store for 2023. Bye for now.